introductions here. So excuse me while I read, and then we'll get into the conversation here. So first we have JORDYN ARONS ROSEN. JORDYN is the National Practice Director of Private Equity and M&A at IMA Financial. IMA is an integrated financial services company focused on protecting the assets of their client base through insurance and wealth management solutions. Her practice provides buyers and targets with a range of insurance benefits and retirement products and services to assist them throughout the life cycle of M&A transactions and investment and risk management following the transaction. JORDYN has more than 13 years of experience in the insurance industry, most of which has been focused on the M&A space. Next, we have Will FLETCHER. Will is a principal of Latticework Capital Management and is responsible for sourcing, executing, and managing investments across various healthcare industry sectors. Latticework is headquartered here in Dallas, and they are a growth-oriented private equity firm focused exclusively on the lower middle market healthcare industry. They have specific focus on executing buy and build growth strategies, allowing its companies to add new service lines and expand into new geographies. Latticework's currently investing out of its second dedicated healthcare fund and actively looking for new opportunities. Third, we have Mike GILLETTE. Mike is a partner in the Phoenix office of Polsinelli, a national law firm with nearly 900 attorneys covering 20 offices across the nation. As a member of the firm's corporate and transaction practice group, Mike specializes in the representation of buyers and sellers in connection with M&A, joint ventures, strategic partnerships, and other complex commercial transactions, with particular focus on healthcare and technology. And last but not least, we have Matt KLAUSER. Matt is a partner and the Dallas market leader for the FORVIS transaction advisory team. FORVIS was created by the merger of equals between BKD and DHG and is currently a top 10 client-focused accounting and advisory services firm. Matt assists private equity and corporate clients with buy-side and sell-side diligence, including pre-LOI, post-LOI, and post-closing assistance. As always, say if there's questions that we don't cover here, feel free to reach out to anybody here on the panel during the conference or afterward. So the way we wanted to tackle this as a group is really dividing the discussion here into two pieces in terms of successful deal transactions and helping close deals. Say the first piece is more the proactive part and a discussion around how do we sort of collectively set up transactions to make sure that they're successful, and then secondarily more on the reactive side, sort of when things go sideways or there are problems, how the folks here really bring them together. So the first part I'll kick to Will. So when you're selling an investment, what are the sort of key pieces of front end work that you guys do to make sure that you can set up a successful transaction and get it to close?
Yeah, thanks, Brian. I would say the first thing we do is probably a third-party QOV. The last thing you want to do is put a book in the market and have your buyers dig through your data and come back to you and tell you your earnings base isn't quite what you thought it was. And so the first thing we do is have someone come in and crawl through our numbers and kind of verify our numbers are what they say they are. And I'm sure some of my colleagues here, Matt especially, can talk to that a little bit further. Another thing I would say we spend a lot of time is data prep. So spend a lot of time centralizing your data, looking at the trends. You know, buyers are going to look at things like volume and revenue by location, by provider, by service line. Centralizing that data and being able to track it and explain those trends is helpful because buyers are going to want to do that. And sometimes those data sets may live in various places. They may have different sources for all of those. And so that's probably the biggest thing where we probably spend 6 months before an exit, really working to make sure all of our data is tight. We know all the trends. We can explain the positive trends that it's going to help our growth story. And then any negative trends, we're prepared to answer that this is why you shouldn't be concerned about that and why it's temporary.
How is it that you guys balance as a seller and a sponsor sort of diving into the detail and putting forward a case that you know is defendable, but it is sufficiently aggressive to accomplish what you guys want to do and sort of monetary return perspectives for you versus the converse from buyers?
Are you talking about in terms of what earnings base we put out?
Yeah, exactly. And putting something that's sufficiently aggressive that you can substantiate that is going to get attacked.
That's certainly a balance, and we probably rely on some of our M&A colleagues that we hire to represent us as to what they see in the marketplace, what they feel like they've gotten credit for. A lot of times I don't think buyers will necessarily tell you I'm paying X multiple on this EBITDA. It just comes through and here's my enterprise value. And you don't always know exactly what credit you get for different types of adjustments, but we probably lean on some of the investment bankers that have experience dealing with buyers in those industries to kind of tell us the market right now will receive this and maybe this one's too aggressive. And that when maybe you present it, but that shows up more in the multiple versus actual EBITDA you're getting credit for because they can't get credit from a lender on the other side.
Got it.
For that particular adjustment.
Maybe Matt, I'll kick to you in terms of that seems to be your day-to-day business. How do you guys approach that? What are you guys seeing in the financial diligence markets around QVs and supporting sellers and buyers?
It's interesting. So first, kind of back to what Will was talking about, we just had your last question about how do you push hard enough, but not too hard, right? Where do you draw the line? So we were doing a healthcare sell-side QOV, which I know we're going to talk a lot about on the panel. And this particular healthcare company had a recent reimbursement change that they switched providers. They went from X to Y for their reimbursement per case, and it went effective 1/1/22. And we were doing a QOV that only went through March of 22. So you have 3 months of good results in our historical period, and however many years worth before then of stuff that's really not relevant because it's at a much lower. And so really what we were trying to do with the management team, with the investment banker on that transaction was talk through, you have to show us, you have to show us some sort of actual results so we have some credibility when we go to market, right? And what I mean by that, it was a pretty complicated formula, right? So management couldn't tell you exactly what the reimbursement per case was going to be. Depends on the case mix and a lot of other factors, but they had their estimate. And really what we were doing with the private equity owner, with the management team, and with the banker was pressure testing. Where's this going to end up when buyers come in, right? So we're talking to you. We were doing it through March. We were probably in May at this time. But July and August, now when buyers come in, where's this rate going to be? And so that was really the sanity check we were going through. And the comment from the private equity owners in that situation was, we don't want to be too aggressive on this. It's going to be a big pro forma adjustment. We don't want to show buyers something. And if we tell them 140 for the rate and it comes out to be 138, I don't want to have that conversation, right, about why you were too aggressive. I would rather tell them 135 and have it be 138 so we have something in our hands. So I think that's just, I know that wasn't the question you asked me, but to keep going on that one, it's something that we've seen that there's a lot of pro forma stuff going on in the market right now. And so something that I've seen on deals is, hey, get what you can, but don't ask for too much because then people are just going to discount everything you do. And so we don't want to lose $1 million for over $50,000. So I've sufficiently used my time answering a question I wasn't asked, but to quickly kind of comment on, what we'll sort of touch on, or what I kind of attribute, a sell side QOV to, or just a QOV period. So quality of earnings report, which Will kind of mentioned, is your accounting advisor sort of sanity check of the numbers of the company that's being acquired. The way I always talk to people about it is, imagine you're selling, not your home, but your favorite NFL player's home and maybe the owner's home, something that's really, really important. And the QOV provider is really the home inspection company that's coming in. And so if you think about the way a home sale really works, the buyer's always going to have an inspection done before they close, right? They kind of agree on the price, and then they say, but subject to the inspection, right? I got to make sure I know what the home inspection comes and tells me. And so I've been doing this 16 years. For the first 10 years, that's really all we did, was buyers hired us to come and do the inspection. And I think what we'll get into throughout this panel is, I don't know, it's no perfect number, but 5 years ago, the situation sort of flipped and sellers started to realize, well, hey, I'm tired of the inspector coming in and giving me this laundry list, punch list I have to deal with, and the buyer's lowering my value when it comes to that after I've already agreed to my value. So as a seller, I'm going to go hire an inspector of my own, and I'm going to do my own inspection on my house, and they're going to tell me where all the problems are. And then I, as the owner, am going to decide what I want to do with it. Am I okay waiting to see if the buyer's inspection finds the same thing? Is there really something in the foundation I need to fix before I take this house to market? And so that's really what a sell side Q of E is. It's designed to identify where those skeletons are, help you figure out what you might want to fix before you take it to market, and then what you just really need to be prepared to defend when you go to market. So I think as we go along, Brian, I'm happy to get into the details, but I think just sort of setting up that foundation is the way I think about it.
Why do you think over the last 5 years it's flipped into being more prepared onto the sell side versus sort of just letting the process play out? And I think this probably will feed through some of Jordyn's comments and maybe Mike's from different perspectives of just the preparedness and being ready for the market. What's driven that? Is it buyer sophistication? Is it just the demand in the market and transaction timing?
Yeah, I'm going to go with D, right? The all of the above answer, but a few things, right? So those of you who have done deals in Europe, Europe started it. They brought it to us. So they were doing it long before we were. And so I think one was the presence of international deals in the US, right? Again, if I go back to the beginning, I was only doing US deals, not even really international subsidiaries. And now at all times we have a deal going on where there's either an international deal or there's an international component. And so I think just the overall international play there came together. I think you have a time where we all, if you haven't heard the history of multiples, but deals getting more expensive also led to increased risk. And so sellers know if I get one shot with a buyer, I don't want to lose it, right? I don't want to go into it thinking I have the diamond that everybody wants and then get into buy side and get torn down and have to start all over. And then 6 months later, I have to explain to a buyer what all these fees were when I went through a deal 6 months ago and it closed, right? Over and over again. So I think a lot of that, and then there's more transition going from founder owner to private equity owner right now. And that has certainly benefited it as well.
Hey, Jordyn, how are you seeing this kind of dynamic play out through your practice and sort of preparedness and the way a change in how people are sort of getting ready for things to come to market?
Yeah, I think it's going to make the reps and warranties, which is a huge part of my practice. It's going to make that go a lot smoother because you're going to have less exclusions, right? I mean, the more diligence you do, the less is going to be excluded and the less you're going to have to hold back for that. I think, working with, in addition to a sell side QV, which can really help, financial statements are going to be the number one claim from a reps and warranties perspective. Now that we've seen kind of all the claims data come in and we have, an eye into that. So, but I think in addition to that, making sure that you're working with, counsel that has gone through, on the sell side, gone through reps and warranties on a deal before, because you don't want to be really figuring it out with them during the deal. So I think between, doing more due diligence and then having counsel that's been, experienced with reps and warranties before, I think those are going to be two key successes for you to have some better terms and conditions when it comes to reps and warranties.
Mike, maybe a similar question. How are you from the legal side seeing clients prepare better, more with more substance behind it, just in terms of transaction prep, documentation, readiness, et cetera?
So I think probably the first thing is that on the legal side, it's not at all uncommon, particularly on the sell side, to first get involved in our transactions, probably post LOI. Doesn't always occur that way, but it's very common compared to the buy side where it's perhaps much less so. So there's a lot of activity and negotiation, valuation work that goes into the pre-LOI stage of a transaction. And I've definitely noticed, I think, a couple of noticeable differences on the diligence side, perhaps over the last couple of years. The first one is no surprise to anyone, relates to sort of valuation issues that's driven, I think, by macro issues that we're all painfully aware of. We're coming up on 2 years of the pandemic and supply chain and what have you and everything else. And, I think as a result of that, among many other things, it produces what are probably viewed as perhaps atypical or unusual results on the income statement on both sides of it. And, depending on which side of the table you're on, you'll want to characterize those things as either, temporary and transitional or part of our new normal and sort of permanent. So I think there's an anticipation of those conversations. And I would actually go a step further to say that if anything, I think it's becoming more so. We'd be hoping it'd be happening less at this point, but I think it's probably happening even more because 2 years in, it's not like things are getting more back to normal. Feels like there's more uncertainty building with what you see every day on the news. And at the same time, sort of the period of what was the old normal, a period of sort of dependable and predictable results, is becoming more stale and more part of the past. So I think those two things combine to sort of impact valuation discussions and how the two sides approach their valuation negotiations. And I think that from the legal side, while it's sort of not our area to do QOVs and get into the financials so much, we're certainly aware of it and ancillary to it. But there's certainly, from my viewpoint, more of a focus on the sell side with the clients, the sellers, their advisors, sort of anticipate these conversations and be ready to explain why, increases in revenue are not related to sort of one-time or sort of temporary events and are going to revert to old means, or conversely, that the increase they're seeing in the expense side, whether it be labor or their costs, aren't permanent, but rather are going to revert. So, there's preparation, I think, that goes into that. So I think that's the one thing. And then second, I would say probably more substantively, I think there's probably increased due diligence on the legal side with respect to certain areas. There's always been an element of sell-side due diligence when you're representing the seller of a company, but I think more so now, particularly in areas like, for example, perhaps employment, ERISA, regulatory, depending on your industry, areas where I think there's a perception of sort of increased risk and activity. I think we're spending more time on the front end, doing due diligence. And actually, in the last several months, there's been a number of times I've actually organized calls with our specialists to, interrogate's the wrong word, but put the client through the same examination that they're going to get when they're on the phone with the seller, with the buyer and their lawyers. Not only just to prep them for it, but so that we can understand, where the issues are as well. And that level of effort, we're probably more reactive to it in the past, whereas now I think we're more proactive and getting ready for it in advance. So those two things I think are definitely, more recent and probably driven by, what we're all painfully well aware of. Just,
I think the dynamic from the pandemic of there's been one of two ways that it's played out. It's either caused a really large surge in revenue and profitability from most firms, or conversely, it's caused them to be down quite a bit. There doesn't really seem to be a middle. And maybe I'll ask Will, like, as a buyer, potentially, when you're looking at that kind of disparity, obviously sellers want to get paid for the full ramp. Buyers want to assume that it's coming down, that's going to create some sort of valuation gap on the buy side. What are the ways that sort of you've utilized as a firm or individually to close those gaps and we solve it with structure and balance that out as pandemic and beyond? Yeah,
we probably use 3 different tools or structures to do that. The first would be an earnout. And so say there's, you have COVID, for instance, and a seller wanted to get paid based more on 2019 financials, but we're in the middle of 2020. Their business is relatively soft, but they don't feel like it long-term impacts their business. And so maybe you throw an earnout so that when they get back to 2019, they get paid. So it's a specific performance threshold and a specific payment. That gets complicated because you're then negotiating how the company is being run in that interim period. The buyer wants no governors on that. The seller wants ordinary course and nothing that would damage my earnout. So when we invest in a lot of founder-owned businesses, and the founders are rolling significant proceeds in with us. And so you then have this awkward dynamic for a year or so where you have your new partner, but you may want to make an investment in a new team member that's for the betterment of the company long-term, but he may not want to have, that be a reduction in his EBITDA during the next year. And so then it just gets to be a hard thing to negotiate to set up. And then it's kind of tricky in that first year. Another way we do it that's probably harder to quantify what the payment would be, but easier to manage, is we call it an equity kicker, but essentially think of it as a different profits interest grant to the seller based on ROI thresholds to us. So once we hit certain ROI thresholds, that equity kicker would vest over those different thresholds. And so think of it as just more ownership in the company on the back end. And so we see some founders really like that. They love owning more, as much equity as possible. They think they have more upside via kind of an equity kicker. And then for us, once the deal's closed, we're rowing in the same direction. There's not an awkward kind of, I want to make this higher, you don't want to make that higher. So I actually love that better. We might, in the end, actually probably give up more value by doing that, but it doesn't kind of create an awkward dance with your new partner. And then the third would be more of maybe leaning a little bit into seller financing. We've probably done that a little more on add-ons than we have for a platform, but particularly for an add-on, if maybe the QV comes in light, or maybe they've had better performance in whatever the valuation gap is, we may not have the leverage capacity or want to put in more equity at the very end. So we might do seller financing. We've used a preferred equity strip where it sits beneath our third-party financing partners, but above our equity. So they get paid out a preferred return of, call it 8%. So for the seller, they get their money plus some level of return in a business that they feel pretty comfortable in. And, they may not want to go put it in the stock market anyway. So that has had some success in bridging gaps, but it does account towards our leverage levels, and we're not putting equity in. So it kind of bridges the gap for both of us.
Maybe Mike, what from the legal side, have you seen other sort of structural ways that your clients are handling valuation gaps that are emerging over time?
Yeah. So I wouldn't say there's been anything, new or novel that we're seeing now that we didn't see before, but I would say that we do see more of certain things now, or at least I do, than perhaps I did a couple of years ago. And I think broadly, they all sort of fall into a structural bucket of some kind of contingent component of your structure, by which I would say, broadly, I would refer to as sort of any structure where the economics aren't fully baked, at the closing, and there's some element, some condition, some variable is not fully known or knowable at closing and will drive economics afterwards. I don't know if I've ever met a seller who wants that in their deal. There's different levels of acceptance of it, but I think all sellers being equal, knowing what they're being asked, would prefer to just get it all at closing and be done with it than to find out later on what it's going to come out to. But I think in the current environment where you've got this valuation gaps, there's a natural tendency to sort of revert instinctively to some sort of a concept where you have some sort of a contingent component where, in one way or the other, the seller's insisting upon a valuation model or metric or way of doing it that makes assumptions about revenue, expenses, or components of the business that the buyer doesn't fully accept, but is willing to structure into a transaction where, if you're right, then we'll have additional upside of some kind if this actually comes to pass. And then you've got different variations of that really only get limited by your imagination. But, broadly speaking, an earn-out is probably the most common one. But there's other variations of that. Like I think in the last couple of years, I've seen more and more use of different retention concepts where, you'll have some portion of the proceeds perhaps put into an escrow or characterized more as a holdback to the purchase price with releases tied to X, Y, or Z. But it all sort of boils down to different ways of getting to the same place, which is having some component of your deal known later on and driving economics that are not fully known on the front end. And with that, I think comes sort of the secondary set of issues, which I think are also evolving, where when you get into any situation where the consideration is contingent on something, you should be driving to the next level, which is how do I resolve this fundamental issue where my money is dependent upon what happens with this thing during a period of your control and ownership. And that drives discussions which can get very sensitive and contentious about sort of post-closing operating covenants, where one way or the other, the seller wants to control or limit or have a say over how the buyer runs and conducts the business, things they can and can't do. And that can be very sensitive for obvious reasons, where the buyer has the position, it's mine, I'll run it how I want to. And the seller's view would be, well, if you want to run it how you want to, then just give me all my money now. And you got to find some way to bridge that. And generally speaking, there should be some set of covenants or agreements that establish some kind of guardrails or rules of the road about how the party's going to conduct, what the buyer can't and won't do, and what will happen and what consequences will follow if they break those agreements or promises. I think there's probably been a bit of a shift perhaps in how those are negotiated over the last couple of years, where, perhaps there's a bit of a shift of the negotiating leverage in favor of the buyers insofar as there's so much uncertainty around us, and we're all well aware of it. That's sort of the common argument that's always been there, which is I need the flexibility to react to what I encounter and run this thing, and I can't agree to have my hands tied in advance, makes more sense and carries more weight now than maybe it did a couple years ago. But there's always still, or there should be, properly constructed some way to provide some set of comfort. And when we deal with the seller in constructing these, the conversation typically follows some variation of, you sort of back into the protections, right? Like, you ask them, if I wanted to screw this thing up, what would I do and what wouldn't I do? And then, they'll think about it and they'll like, well, I'd fire that person, or I wouldn't renew this contract, or I wouldn't invest in this. And, then you start backing into protections which prevent those results. That's the way those conversations should go, as opposed to just trying to have like sort of a one size fits all or general restrictions, which can provide for sort of less certain relief. So I think we see more and more of sort of that, variations of that. And I think we'll continue to, broadly, as long as sort of the uncertainty continues, and then probably for some period after, while we, establish a track record of what people will look at and refer to as being sort of dependable, ordinary course results, which can serve as the basis for a dependable valuation, which, once you can get there, there's less of a reason to begin with to not just structure it where the economics are known on the front end, because you know what you need to on the front end. So, I think it'll continue, but ultimately these things go in cycles, and, I think it'll ebb with time as we get back to more and more of a normal, whatever that looks like. But in the meantime, that's some of what I see from where I sit.
I would just say that some of this fine dance and things that you guys have mentioned here, between the buyer and the seller, especially, after the deal is closed. I mean, this is why reps and warranties has become the norm. I mean, deal size obviously considered, but it's become the norm because it, besides the money factor and not having to put all that in escrow, you're saving that relationship, and if something comes up with the reps, you just go to the insurance carrier and you don't have to have that contentious experience.
Yeah. How has the rep and warrant market evolved into some of the smaller deals? That even in our business on the lending side, that's been one of the things that sort of, over the past decade, sort of the advent of rep and warrant and having a third party to go to was even a new concept, and it seems to be evolving. And you mentioned earlier, sort of now some of the insurance companies are starting to get sort of experience and loss, and how is that affecting sort of availability of the product across different deal sizes, types, and structures?
Yeah, I mean, I think from a size, so a couple questions in there.
Yeah.
So I think from a size perspective, we've really seen that come down. I mean, a couple years ago, the threshold was absolutely, 50 million from an enterprise value perspective. And I think, not that you couldn't maybe on a one-off, but in general it's 50. And I think now, I mean, you can definitely, we've done some in the 16 million and range. Very recently, I think 25 million is kind of the standard threshold, I would say now. So we've pushed that down. And then, there are some markets out there that are actually only even looking at, deals that are 100 or less. So they're not even looking at the bigger deals. So they're specializing there and they're finding their niches. And, as more markets, they enter into it, right? As the carriers go, they're going to put pressure on each other. So you're going to have some that are focused on smaller deals. You're going to have some that are focused on specific industries. You have a couple that are even focusing on some sell side products. You've got that increase in the usage of reps and warranties has really increased in that. And that has also led to an increase in hiring, right? So being able to hire more folks to handle the deal flow, making sure that you're hiring folks that specialize in industries that might have been more of kind of a no-go before. Like there is an expansion on some healthcare stuff or oil and gas. There are a couple carriers that'll play in there, like a Tokyo Marine.
What is it that's been driving the interest in smaller deals? Is it just loss experience in the bigger deals has been acceptable and there's profit potential down on the lower end?
I think that there's a need, right? I think that folks have been, if they've been involved in some of the larger deals and they see the benefit of what reps and warranties can do, especially from that relationship standpoint after closing, I think that they were interested in it. And there was always questions, can we do this? Can we get it? How, this deal is smaller, but you can tweak the limits, right? So instead of the standard being a 10 million, you can, or a 10%, you can go up to a 30% on some of these smaller deals. You can do, excess layers for fundamentals only. So I think the need has really been, the demand has caused the increase, right? So
There's profit.
there is profit, yeah. And the fact that now, sellers are pretty much expecting that the buyers are going to be kind of providing the reps and warranties. And before it might have been a 50-50 split on the premium, might have been a 50-50 split on the retention. Now it's kind of, in a lot of cases, it's going to be expected that the buyers are going to be, the reps and warranties is going to be part of the process. And then that changed the terms of the deal. They might be more willing to accept kind of buyer-friendly terms if they know that they're going to be able to rely on that reps and warranties policy.
Got it. Maybe switching gears just a little bit, Matt. We talked a little bit about exogenous factors in the market causing people to rush to market, a different tact, a different angle on some evaluation gaps. We saw sort of, I think last year, a lot of people rushing to market in front of tax changes and things like that. Maybe from your seat and what you see on the financial diligence side, what suggestions do you have for people in terms of sort of a quick maybe hit list of things that, as you're seeing folks go out quickly where they may need to pull something together, that there's a list of things that can really ease the pain or help bring something to conclusion relatively quickly?
Yeah, so it's dangerous, right? To say, how do I? It's the whole, can I do it fast and cheap and like it inaccurate? It's hard to do it all. But I would say, kind of bridging some of the comments here. So we get into the Q of E all the time, and the historical numbers are tough, right, for buyer and seller to agree on a valuation. And so like Will, I guess Will and Michael both mentioned the concept of an earnout, and they also both mentioned some of the consequences of an earnout, or some of the problems that can come from using an earnout. And so one of the things that I've seen, particularly since COVID, right, which COVID introduced, as we've said, well, hey, I'm charting, if I'm looking from my left to right, I'm charting my financial results, and all of a sudden this is what they looked like. But trust me, right, it's going to get back there. Now we're a little bit on the other side, depending on what industry your business is in. A lot of companies can show the recovery, right? And they can show that the dip happened and we're back, and just ignore this part of my history. Some of them aren't all the way back there yet. And so a lot of what we've seen is heavy diligence on projections. Whereas before, the projections were always kind of between the broker and the buyer, and the Q of E provider stayed on the sideline for that part. We started doing a lot of buy-side diligence, a heavier buy-side diligence on the projections, and really helping advise our clients on how likely we think they are to get there. We're not developing projections for anybody. You didn't hear me say that. It's going on record. But we are helping, assess what the risks are in sellers' projections. And so, like, things we're going to ask you as a seller as well. Tell me how you've tracked backlog historically. Have you ever thought about tracking backlog, or is now the very first time that you're going to tell me you have $20 million of backlog? But I can't really track historically whether, one, that's accurate, and two, it's really going to flow through to revenue. Can you tell me your win rate on your proposals historically, so I know for every dollar of proposal that goes out the door, you win 35 cents? Can you help me at least, quantitatively start thinking through how much credit I can give you as a seller, right? And so, and then depending on your business, right? What's the main cost input? Is it a material cost? Is it a labor cost? How have you tracked on that historically? So that's really something just outside of the standard. We have to do the historical Q of E. We have to figure out what the working capital target is. we have to define indebtedness, all that fun stuff. Doing extra diligence on projections is what I've seen, because I know you teed up one of the questions, which is, well, hey, sellers want to assume it's all back and buyers want to assume it's not. It's interesting for all the private equity groups who need some added reputation bonus here. Most of what I see is buyers want to give them credit for it too, right? They want to get deals done. Sometimes it's the bad Q of E shop over there that's telling them it's not very likely to happen, and so that's something we've seen. And I'll just end it with, we're doing a sell side Q of E right now that has projections in the scope, right? So I think sellers are starting to realize that too, and say buyers are going to beat up these projections. I can't just have a sell side done historically. I need that to include the projections as well.
For whatever it's worth, we do that as a lender too, and add that into the scope. Maybe one more round robin, and we can have questions if there's time. So how have you guys seen sort of all the dynamics that we've talked about evolve maybe over the last 2 to 5 months with sort of volatility that's emerged? I think a lot of what we're starting to see is of the pandemic folks that went up. Some of them are starting to see some of that softness, and sort of just what the current environment's looking like, and how sort of deal making over the next year to 3 years may evolve, and based on what you guys are seeing today. Maybe Will can start.
Sure. We certainly see plenty of activity. I think, to your point, the companies that went up are starting to come down. The revenue side is probably back to normal for the most part, at least in the healthcare market. Right now, we're focused a little more on kind of getting squeezed from a labor perspective is probably the biggest thing we're focused on, and just making sure our turnover is as low as possible. But otherwise, the market is still robust and lots of opportunities, and certainly plenty of capital to go after good opportunities. We're not getting there's plenty of people out to put money to work, I guess.
Yeah. Matt, are you starting to have to normalize for the down in financial performance, or people still claiming it's a temporary?
Yeah, so I agree with what Will said. For the most part, revenue's back right across the board. I'd say in 2021, if I get my years right here, that's where for the manufacturers in the room, the whole commodity, the real commodity pricing hurt them, right? So across the board, margins were down. And I think Michael said, well, hey, is that the new normal, or is it, an aberration? And so that's really what we were focused on for a lot of those companies in 2021. But it gets back to what I said before. At some point, you have to give me some data to suggest what's going to cause it to turn around. Otherwise, I'm led to believe it's the new normal, right? It's hard to buy the story. So that was really a lot of what we saw in 21, and then just piggybacking off of in 22, we've seen a ton of pressure on labor costs, right? They're through the roof. When I'm talking to a business owner, I can share how much our payroll's up per head, and it's annoying. Then I have people like Will saying, well, why are your rates up? And I said, well, remember, my payroll costs are up. And by the way, I'm an accounting firm, and that's my real cost here. So we see that with sellers as well. And that's what we're trying to figure out.
Maybe Mike and Jordan, same question, and then we'll kick it to questions.
I think for us, we're seeing deals getting done in much shorter timelines. So for us on the reps and warranties side, 2 weeks is becoming quite normal. We can get it done, especially if there's a sophisticated buyer with counsel. I think you're seeing more reps and warranties for corporates and strategics, and not just PE. Like I said, the smaller deals, the tweaking of the limits there. Markets that are now able to do some minority deals, some 363 bankruptcy deals. That's a little bit newer. The increase in the no seller indemnity deals is really from the kind of proliferation of the reps and warranties insurance market. No seller indemnity quote is going to only be, is only a little bit more expensive than a limited seller indemnity quote. It's not by much. So, and I think just making sure, retentions. So, retentions used to be 2%, and now it's standardized, it's 1%, right? So that's gone down. So that's another change. And I think we haven't talked about it on this, but just the increase in cybersecurity due diligence. We don't have anyone up here for that, but I think, that can obviously really help from a reps and warranties insurance perspective. And then also from, we don't just do reps and warranties. There's insurance on the other side of it, of course. So there's, cybersecurity and cyber insurance. So I think those are some of the things that we're seeing, change and that have changed and that will continue to change.
Mike, what are you guys seeing from the legal side?
I would say on the legal side, it's been fairly consistent over the last couple of years. I think probably, of late, perhaps, I would call it sort of maybe a minor tick down in activity, but it's still, from frenetic to just sort of, merely crazy. I mean, it's really the entire scale and sort of frame of reference has changed over the last couple of years. So I think long story short is we still see a tremendous amount of deal activity happening. I tend to think I like to give us credit sort of as a whole to have gotten used to and good at absorbing and dealing with sort of, chaotic and sort of substantial changes like over the last several years. Whereas if you think about it, like in the last 60 days, we've, endured 40-year high inflation, a war in Eastern Europe, and inflation and, and interest rates jumping by, several points. And, if you asked somebody 10 years ago if all that was going to happen in 2 months, what would happen? They would tell you the world was going to end, and we're just sort of, yawning and moving on. And, I think there's something that's to be said for sort of as a whole, how we've gotten accustomed to, sort of abrupt and substantial changes. So I think long story short is I think deal activity will continue to happen. We'll continue to see deals getting done. People will adjust and, the market will calm down. I think there's a tremendous amount of capital still chasing good deals. I think if there's anything I see in particular that might be a symptom of sort of the most recent events, I think I've personally seen, I would call it sort of a small uptick in sort of the use of seller carryback notes where, you've always seen them, but I feel like I've seen a couple more in the last couple months than I would normally expect to see in the span of a couple months. And, what that's attributable to, whether it's rates or available capital sources or some combination of those two or other factors, I couldn't say. And maybe it's just sort of anecdotal and not really a symptom of anything. And but in any event, that's one thing I would point out that, in particular that I've seen. But overall, I think we're all still getting things done, and I think we'll continue to.
So we have a handful of minutes left. I don't know if there's a microphone in the audience, but we're happy to take questions from folks.
Yeah, I have a kind of a giant issue. I was going to ask Matt about this, is that there's very quality in the people that are doing quality of earnings out there.
There's very what?
Very quality people that are out there. And, the people that are doing this are supposed to have skill, knowledge, and experience to really execute this. But if you're on the sell side, and the quality of earnings guys miss it, you sense it, how do you approach that on the sell side to push back and challenge the accountants? Because they're not economists, they don't understand elasticity of demand, they're not financial analysts. I'm an accountant myself. But when you see that, like there may be a situation where should you say, hey, if these guys are your auditors, they're not doing the due diligence. They're not doing the quality of earnings and stuff. And you may have a working capital. Gross up the assets, and then when the quality of earnings team moves on, there's significant understatement of liabilities. And then post-close, when they do the working capital adjustment, there's several $100,000 whack.
Yeah.
So how so depending on so you have some people that they're just intellectually honest, they go in, they do great work. But then there's a situation where how do you challenge people that have never developed financial models that don't understand economics?
Yeah, well, not completely joking, but I would say the easiest way to find those people last year was to call them and ask them how quickly they could start a Q of E, right? And if they could start tomorrow, then you found one of the people. But so I hear your point, right? I mean, I see it, and to be, with integrity in the profession, we see stuff we don't like all the time, and I would like to think that sort of a rule plays that those groups are I talk to clients all the time or prospects all the time who tell me, well, I'm never working with that group again because of something like that. So I think those groups tend to, limit their business pretty quickly themselves. They don't need help from us to do it for them for the most part. But to kind of specifically answer your question, my approach has been to find the one advisor on the other side that I can actually reason with, right? Like most of the time, I'm going to be talking to the accounting advisor on the other side. But if they're completely unreasonable, then I can go to their attorney or I can go to the investment banker through my client and get to somebody who I can have a conversation with and try to work out, I was on a deal and, first plug for people, whoever set it up here, for people who actually work on deals, like, don't use just a normal accountant or lawyer or whomever who doesn't work on deals, but they had no idea what a working capital target was. They had no idea what we were trying to do. And they were just arguing with everything. And so eventually we just called this selling shareholder and said, look, we're only going to have discussions with you. Your accountant's doing you a disservice. So I would say reach across the table and find a different advisor when you need to.
But what happens if the quality of earnings people are wrong?
Well, wrong is in the perception of everybody's opinion, probably.
Yeah. Earnings might come up with assumptions, but people aren't skilled enough to interpret the data. If they're off and they're pushing the buyer, how do you challenge that, and how do you snuff out issues when things
For whatever it's worth. Yes. So I'm an underwriter by training on the investment side, and I'd be interested how Will reacts to this. For us, everything's rooted in the data, right? The numbers say what they say, and the trends are what they are. And we hire professionals alongside of us to help craft the structures and narratives around what's happening. But fundamentally, if you have somebody who's arguing with facts, there's not a whole lot you can do. But we sort of always distill it down to, here's what the numbers are, here's what the trend is, here's what they're saying, here's what we believe to be true based on what we see. Let's have a discussion and debate about it. Just professional liability insurance, I suppose, is the only way to combat somebody who's just flat out wrong. But that's typically how we approach it.
I would say one thing we do is, we certainly hire people that only work in health, or not only, but significantly work in healthcare from an accounting standpoint, just because the revenue components in healthcare can be kind of challenging from a recognition. But when we find issues, we usually tee it up. To your point, the data is what it is, but we kind of present it as though, here's kind of what we're finding. Why don't you tell us what, are we missing something to come to this conclusion? And not necessarily phrase it as, hey, your numbers are bad and you're off. More of a, hey, help us understand why we're seeing this. We're probably missing something. Maybe you can help shed some light on it, and phrase it in more of a soft approach. And then also try to maybe not do it in front of their client is a good way, just to help the relationship a little bit, not call them out in front of their client, but kind of phrase it more as a, hey, I'm kind of coming up with this. I think I'm wrong, but maybe why don't you help me, tell me where I'm wrong or why I'm missing this or getting to the wrong answer.
And I can understand yet where somebody just wants to argue. This world is full of it.
Well, then you just tell the owner, I'm sorry if he doesn't want to lose you as a client, so he's going to kill the deal. And that's the problem.
Well, our timer is officially over. So thanks everybody for attending, and enjoy the conference. Thanks everybody on the panel.